So what is technical analysis? Technical analysis is a branch of trading analytics which focuses on the study of price. It's often applied at the same time as fundamental analysis, the study of economic news. Technical analysts attempt to identify scenarios where the price of a currency has a high probability of moving in a certain direction. A scenario such as this can be a signal to the investor to either buy or sell that particular currency. In short, technical analysts look for signals to buy or sell based on previous price levels. Analysts go about this task by turning to their primary source of information, charts. Watch the next clip for more. Technical analysis can be applied in one of two ways. The trader makes trades based on a strategy that relies on the signals generated from the analysis of price charts. This requires not only a strategy based on a deep understanding of the concept of technical analysis, but also requires strict money management to limit risk and ensure long-term profitability. Or, the trader applies technical analysis in conjunction with economic news, such as an earnings report, a central bank statement, or an economic indicator to identify trade opportunities. If, for example, economic news and indicators increasingly point towards a strengthening of the US economy, a trader could support this information by using technical analysis. This would help identify a trade opportunity in an instrument that's representative of the US economy, such as the S&P 500 index, an index tracking the 500 largest companies in the United States. As you progress through our courses on technical analysis, you'll gain an understanding of a variety of tools and methods that will allow you to apply technical analysis according to your own trade preferences and strategies. What is a chart? A chart is the most important source of information for technical analysts. It is, simply put, the illustration of price. For example, looking at a chart displaying price levels over a year, it's easy to see how a currency has performed. On any chart, the price of a currency, or any other financial instrument for that matter, is plotted against time, and the resulting line displays the performance. Time frames. When looking at a chart, each point or bar on that chart represents the price levels for that chosen period of time, and this is called the time frame. If, for example, you're looking at a one-day time frame, also called a daily chart, each point or bar on the chart is the price for that particular day. One point on the chart is 1 day of time. Therefore, if the time frame selected is an hour, then each bar on the chart contains the price levels for 1 hour. Japanese candlesticks get their name from their country of origin, and the fact that the bars displayed on the chart itself resemble small candlesticks. Each part of the candlestick represents one of the 4 price levels mentioned before. So let's explore the basic components of a candlestick's anatomy. The solid body of each candlestick represents the distance in price between the opening price and the closing price. The distance between the highest price reached and the body is called the upper shadow. The distance between the lower price and the body is called the lower shadow. The upper and lower shadows are also sometimes referred to as the wick and the tail, respectively. The distance between the highest price and the lowest price makes the entire price range for the time frame that the candle represents. If the selected time frame is 1 day, each candle would contain the price levels for 1 trading day. The price range will naturally vary, which creates different looking candles, where the length of the body, tail and wick can be vastly different. If a currency has gone up 1% from its opening price, then plummeted down to -2% and finally closes at -1%, the candlestick would look like this. Now, not all candlesticks have this particular form. At times, the opening price will be the same as the lowest price or the highest price. And likewise, the closing price may be the same as the highest price or the lowest price. When the closing price is higher than the opening price, the value of an instrument has increased, and the candle is usually attributed with a green colour. If the closing price is lower than the opening price, the value of the instrument has decreased, and the candle is given a red colour. Depending on your preferred charting software or custom settings, these colours may vary, denoting a price increase and decrease respectively. In addition, there are candles where the opening price and the closing price are identical, which results in a candle without a candle body, as illustrated below. In case that little or no trading activity has occurred and the opening highest, lowest and closing prices are the same, no body, upper or lower shadow is seen, and all four price levels are denoted by a horizontal line. This is an example of a candlestick chart for Euro-Dollar, where the daily time frame selected is 1 day. Therefore, each separate candle represents the four price levels for 1 day. The colour and visual nature of the candlestick charts make it easier for the investor to identify periods where prices have either continuously decreased or increased. Specific candle formations or successions of candles may even serve as a signal to the analyst that the instrument price will go up or down. This type of candlestick study, where candle formations serve as a signal to trade, is referred to as price action analysis and will be covered in depth in a later course. Before moving on to other chart types, let's have a look at candlesticks in relation to different selected timeframes. In this Euro-Dollar chart, we've selected the weekly timeframe, meaning that each candle on the chart represents the four price levels for that respective week. Also, please note the price levels for this candlestick are displayed in the box at the lower left corner of the chart. Let's single out the week beginning on March the 9th as a subject for this example. Now, since Forex markets are open 5 days a week, this means that 5 daily candles make up one weekly candle on this chart. Let's have a look at how that works. Here's the weekly candle from the previous chart. So how is it constructed? Well, as we know, 5 daily candles create a weekly candle. Notice how the four price levels still correspond, and all 5 daily candles are contained within the weekly candle. The first of the daily candles matches the opening price and the highest price of the weekly candle. And as we can see, the lowest price and the closing price were both set on the 5th and final day of the week. In this Euro-Dollar chart, the daily time frame has been selected. Each section shown here illustrates the price action for one full trading week. The sections correspond with the time periods along the horizontal axis. Be aware, when you select a new time frame on your chart, the horizontal axis will automatically scale accordingly. The bar chart is quite simply the skinny version of a candlestick chart. It's also called an OHLC chart, as an abbreviation of the four price levels: open, high, low, close. It's essentially the same as a candlestick chart, with the main difference being that the distance between the open and the closing price does not make a body, but instead simply a line, as shown here. The opening price is the horizontal line on the left side of the vertical bar, and the closing price is the horizontal line to the right. This is an example of an OHLC chart for euro-dollar. In this example, the bars where the price has increased are green, and the bars where the price has decreased are red. The colours may vary depending on your custom settings. A line chart is by far the simplest chart an analyst can look at. This is due to the fact that line charts only display one price level, the closing price. As such, this type of chart completely disregards price fluctuations within the selected time frame, which gives it the benefit of simplicity. Traders and investors can therefore quickly evaluate the general direction of the price. So let's review what you've learnt in this introduction to charting. Technical analysis is the study of price plotted against time on a chart, and this is the primary source of information. Shorter time frames give a detailed look at price fluctuations, while longer time frames give a greater overview of the direction of an instrument's price. Technical analysis can be applied as an independent source of trade signals or in conjunction with broader input, such as market moving news information. Candlestick formations on Japanese candlestick charts can be used as signals to either buy or sell, but these are only signals, they are not defined trading alerts. OHLC charts are essentially the same as candlesticks. Line charts are used for a simplistic overview.